let's talk about the accounting cycle. The accounting cycle is like an 8 or a 9-step process whereby we create the income statement, the statement of retained earnings, and the balance sheet. Step 1, we analyze business transactions to see if there's something for us to record. So if there's something that can be reliably measured in dollars, we will record it. Not everything gets recorded in our accounting records. For example, Freddie of Freddie's Auto Service rescues a motorist on the freeway and shows up on the news as a hero. That's good for business, but there's no way to reliably measure how good that is for our business, so there's no journal entry for us to make. Step 2, if there is something to record, we record it with a journal entry. Journal entries use debits and credits. Debit means left, credit means right. One isn't good, one isn't bad. Our rules are assets increase with debits, liabilities and shareholders' equity accounts increase with credits. Expenses are debits, expenses are debits, expenses are debits. The opposite of expenses, which is revenue, must be credits, and dividends start with D, and that reminds us that they're recorded with debits. For example, Freddie's Auto Service sells $50,000 worth of common stock at par value. Debit cash for $50,000, credit common stock for $50,000. Step 3, we post or copy all the journal entries to individual ledger accounts. So once we've done the journal entries, we have everything in chronological order. All we do is reorganize it by account. And in accounting class and in the real world, we often use T accounts to symbolize the ledger accounts. For example, after that last transaction, we have a balance of cash of $50,000 and a credit balance for common stock of $50,000. Step 4 is to prepare a trial balance. We list all our accounts in the special order: assets, liabilities, owner's equity, revenue, and expenses, and we list the balance in each account. Notice there's not a debit and a credit next to cash. The balance in cash, when we offset all the debits against all the credits, the balance in the cash account is $36,800, and hopefully all our debits equal all our credits. If they don't, we know we've done something wrong and we have to go back and double check ourselves. Step 5 is journalizing and posting adjusting journal entries. We want to get our expenses and our revenue into the right periods, and those right periods don't necessarily correspond to when cash was exchanged. For example, on June 1st, let's say that Freddie's Auto Services signs a 3-month lease, $1,000 a month, and the landlord wants all the rent up front. So we cut a check for $3,000, and we can't debit rent expense because that's for 3 months. We just want to book 1 month worth of rent expense in each of the next 3 months. So what we do is, in accordance with step 2, we journalize the transaction by debiting an account called prepaid rent. That's an asset. Assets increase with debits. And then at June 30th, we debit rent expense and use up 1 month of that prepaid rent by crediting that asset for $1,000. So now we've got that 1 month worth of rent expense. We'll do the same thing with supplies. We'll do the same thing for insurance that we prepaid. We'll do the same thing for depreciation expense. These are all adjusting journal entries. Step 6, we prepare an adjusted trial balance. So looks just like the trial balance, except some of the amounts have changed due to adjustments that we've made. Again, we just have one number next to each account. That represents the balance in that account as of, in this case, June 30th, 2014. And again, all our debits should equal all our credits. Step 7 is to prepare the financial statements. That's the whole point of the accounting cycle. Here's that same adjusted trial balance, but I've color-coded it down here at the bottom. These are our income statement accounts. Here's the accounts we need to create our statement of retained earnings, and everything above that is the balance sheet accounts. So you can see our income statement is revenue minus expenses. Our retained earnings will be retained earnings at the beginning plus the net income minus the dividends. So creating our financial statements from the adjusted trial balance is pretty simple. Here's our revenue minus our expenses to give us our net income. This is the single step format, and these numbers are taken right from the adjusted trial balance. Then we take our retained earnings at the beginning plus our net income, which is this $2,900, subtract our dividends, and that gives us retained earnings at the end. Then we just list the balances for our balance sheet accounts, except that in the retained earnings number, we use the number we just calculated, and we should have a balance sheet that balances. Step 8. Remember, retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. We did that calculation on a separate piece of paper and put that ending balance of retained earnings on our balance sheet when we showed it to the world, but we haven't done that in our accounts. So that's what we do. We'll take our beginning balance and retained earnings and we'll add to it net income, which is our revenue of $7,500 and our expenses of $4,600. Well, how did they get there? Well, our revenue account had a credit balance, so we'll debit it and then credit retained earnings for $7,500. That'll make the balance in the revenue account zero. And all our expense accounts will credit those and debit retained earnings for their total of $4,600. So now every expense account has been credited for its balance, so now it has a zero balance. And finally, we subtract dividends from retained earnings because retained earnings at the beginning plus net income minus dividends gives us retained earnings at the end. Then the last step is to prepare a post-closing trial balance. So our retained earnings should have the updated amount in it. Dividends, revenue, and expenses should all have zero balances. If we do a post-closing trial balance and there's still an expense left, or a dividend balance left, or a revenue balance left, we know we didn't completely close out those accounts in step 8. And once we've done step 9, we start all over again with the accounting cycle for the next period.